Welcome back to another episode of FPOG, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to talk about why is your investment allocation probably wrong? We'll go through the 5 most common errors that we see, and then we'll also briefly talk about, okay, in light of that, how do you construct the optimal investment allocation? But Justin, that's a technical word. Like let's go 1.0 and talk about, okay, what do we mean by investment allocation?
I think the simplest definition is investment allocation is how all of your investments are structured. So allocation is whether you have 3 different accounts or 13 different accounts across all of your investment accounts. What are they invested in at a high level between stocks, bonds, cash, real estate, or other investments? And then you could also dive deeper into what does your allocation look like across within stocks. It could be how much small cap, large cap exposure do you have? Are the companies that you invest in, are they US or international? Are they value companies or are they more growth oriented? And so I think allocation at its simplest form is just how are you invested? What are you invested in across your different accounts? Jared, what would you add to that?
No, I think that's right. It's just literally like, what are the underlying investments you own globally across all of your accounts is what I would say an investment allocation is. But I guess 2.0 of that, like, why does it matter? And like, I guess a kind of adjacent question is like, why is it personal? Why doesn't everybody have the same investment allocation? And why is it different?
Few things come to mind. Jared, tell me if you disagree with this. I think your allocation today is probably the number one determining factor of what your returns in the next 20 years will be. What do you think about that?
I think it's secondly important because of behavior, but it's other than behavior, right? Like if you and I both own an 100-0 stock bond portfolio, 100% stocks, and I sell at the bottom in 2008 and I never bought in, I was technically in 100-0, but you and I's lived experiences were drastically different. So assuming that you actually find the appropriate portfolio that is in line with your risk tolerance, that we'll talk about later, and you hold it indefinitely, the single biggest driver, I think, of investment returns is your investment allocation. You know, what you invest in and what those investments return, that's investment returns right there. It's just the way it is, assuming you could stick to the portfolio.
Great point. If someone was passively investing $5 million in 2009, if that person had 40% stocks and 60% bonds, they have way less money today than someone who had 90% stocks and 10% bonds in 2009 and let that $5 million just passively compound over the last 15 years. So it's a massive determining factor in your returns, but behavior is such a critical part of that too. Can you stick to what your allocation is?
Yeah. Okay, awesome. So let's talk about why we think odds are your investment allocation isn't what you think. And like, I want to get back to the idea of like the account level view versus the household level view. And like you mentioned that, you say, hey, what is your global investment allocation? So your allocation across all of your accounts and how do they work together? You want to unpack kind of what we mean by, hey, fixating on an account level allocation versus the household level allocation when those two kind of become mismatched?
Yes. I would say that household allocation compared to account level allocation, the biggest hiccups, there can be a few problems here, but at a household level, let's define that term. Household allocation is maybe you have 6 different accounts. Maybe 2 of them are pre-tax 401ks. And I'm not sure why if you're watching us on YouTube, I put up the number 2 and balloons popped up. So that's a little plug for all of our listeners out there. Maybe you need to log on to YouTube. Maybe you need to watch us do this live. You never know what surprises are going to come. Back to the topic. So account level versus household. A household allocation is maybe you have 6 different accounts. 2 of them might be pre-tax 401ks. 2 of them might be Roth IRAs. And then 2 of them, or let's say 1 of them is a joint brokerage non-retirement investment account. And another one is a joint checking savings account. So it's important to understand your household allocation is the combined allocation of those 6 different accounts that span across different tax registrations and different time horizons and goals. So household allocation could be very different and really should be very different than your account level allocation. So I mentioned a household allocation with 6 different accounts. If someone is diving into what is my account allocation, they might just be looking at what is one of my pre-tax 401ks? How is that one account invested? What else should we cover here, Jared?
We've talked about it in past episodes, but asset location, i.e. structuring, picking which investments go into which account, there's potential tax advantages to not looking at everything identically. So like, let's say we use the token 60-40 portfolio. There are strategic advantages to not having every account allocated at a 60-40 allocation. But that being said, you still need to decide, hey, what is my global allocation? What is my total target? And then making sure that of the 10 accounts that I have, if I add up all the assets in all those accounts, it adds up roughly to an investment portfolio that I'm consistent with. Because a lot of times you'll manage this piece and manage this piece, and there's constraints, right? 401k options, the menu is limited. A brokerage account, there's embedded capital gains, right? So not everything you could just easily rebalance and make exactly what your household allocation is, right? So really it's just an encouragement to say, hey, account level, there's benefits to making it different, but you also need to look at the household and aggregate it and consider, hey, on an ongoing basis, do all of these parts add up to the whole? And do I have a whole strategy set in place?
I think a quick point that I would add, one of the negative things that we will see from other investment statements that we're reviewing, it is not a good thing if your asset manager is taking your Roth IRA, your pre-tax 401k, and your joint brokerage non-retirement investment account, if they are just giving you a risk survey and they're saying, okay, you should be in a 60-40 portfolio. You should have 60% stocks, 40% bonds. Here is our model portfolio. They give you a list of 10 mutual funds. If they are just copy pasting that portfolio into your pre-tax IRA, your Roth IRA, and your non-retirement investment account, that is a problem. A much better scenario is, hey, the Roth should be 100% stock. The brokerage account, there could be scenarios where that is way heavier in stock, depending on time frame and where you're taking income from. And then the pre-tax IRA, that is subject to future income taxes. That is probably, from a tax perspective, the most punitive account, and we want the lowest amount of growth in that account. And so, big problem if you have 3 different accounts and this just copy paste the exact same canned portfolio into all of them.
Yep. And 2, right? Like in the AUM advisor scenario, they are likely giving you a canned model portfolio based on the assets they manage, while not looking at the household total, right? Or advising on the household total. So, it's just step 1 is really awareness of, hey, what are my asset allocations? And we'd argue they both matter at the account level and the investment level. But Justin, let's go a step deeper, because it's funny, like we say, hey, know your allocation for all your accounts. But then I think one of the big problems is, like, sometimes people's investment allocation, review, let's say, hey, I do want to review all my accounts. It's not actually reflective of their balance sheet, right? And like a great example of this is a pension, right? Like, you don't think of a pension as an investment asset because, you're not really funding it. It's not really invested in the market, but it is a future stream of cash flows or a lump sum quantity. And it has very little market risk. And depending on who your employer is, it does move with interest rates a little bit. So it's more of like a fixed income instrument, right? And so if you're actually going to look at the household balance sheet, your pension is a substantial, I would argue, fixed income like asset, not identical, but structurally similar in terms of volatility of the account and, paying you future cash flows and being very income centric, right? So like, I would argue that piece of the bucket matters. But if you add the pension to the balance sheet and your investment allocation, you can likely get a lot more aggressive with your other assets. What would you add there?
One of the biggest complaints I hear from other advisors, one of my biggest problems with big nationwide investment firms, it is amazing that they have no ability to take this into account. So, Jared, if you're at a big nationwide firm and you've got a $2 million pension that you're not going to take for 5 years, it could absolutely be in your best interest, especially if you can stomach the volatility. It could be in your best interest to have a 90% stock, maybe even 100% stock portfolio, even though you might be 58 years old, 61 years old. And so a big, investment firm is going to look at that and they're going to flag your account because of your age. And they're going to say, hey, you shouldn't be 100% stock. What is going on here? And it's this clear example of, a giant box firm is trying to have the easiest asset management process possible. They are trying to just copy paste their list of, 10 funds, or maybe it's 80 different stocks. And they're trying to put 4 million different clients all into the same portfolio. It's drastically easier for their operations to do and execute portfolios that way. But that is a huge problem. If you have, 60% of your money is liquid and then 40% of your money is in a pension, well, that pension is a giant bond. That pension is an incredibly safe asset, 9 times out of 10. There are small exceptions there that we don't even need to dive into. But Jared, you're absolutely right. 2 things need to be accounted for in your balance sheet. If you have a pension, that better be accounted for. So if you are a 60-40 portfolio, well, if you have a pension, no, you're not. You're probably more like a 40-60 or a 30% stock, 70% bond portfolio, because your pension better be counted in your total allocation. Jared, there's another one. Social Security. Social Security should be counted as an asset. If you're 62, 64, 68 years old, you can essentially take a present value calculation of what your Social Security is worth, and that should be included in your allocation as well.
But here's the thing. I'd argue that if you do take this route, you need to review your balance sheet on an ongoing basis. You need to track net worth, right?
Yep.
We'll use simple math to make it easy. If I have a $4 million portfolio, 2 million of that a pension and 2 million of that is all equity, right? Just to keep it simple. And your $2 million equity portfolio is down 40%. Man, that feels drastic. But in light of a pension, let's say it's flat. It's not up or down. You're actually down about 20% in terms of investment assets, right? Considering this pension asset. So, you need to be able to stomach and be comfortable with the drawdowns, but you need to right size the drawdowns, right? And there will be drawdowns. That's a function of market participation, right? That's why you get compensated over the long term. But if you do incorporate these assets, you need to review and analyze the balance sheet on an annual basis, because it'll help right size drawdowns, right? We don't want to minimize drawdowns, and drawdowns are really painful. And any account being down 40% is, it's tough to swallow. But remembering how your whole investment portfolio is structured hopefully makes it more manageable and digestible.
That's right.
I do think we should pause here, Justin, because we say, hey, everything needs to be included in the household allocation. I would argue everything that's invested for the same goal, right? So
that's good.
Pension,
yep.
401ks, brokerage assets, those are all retirement, future spending assets, right? Like 2 examples of stuff where I would exclude it because it serves a different function: 529 plans and donor advised funds, right? Because your charitable ventures have a different time horizon than your retirement ventures. Your college funding ventures and your child education's expenses have a different time horizon than your retirement assets. So barring, I do think it's worth, before we go any further, saying, hey, there is an instance where excluding it from the assets makes sense, but I would say it's all a function of bundling based on the goals. So what bucket of money, what bucket of accounts serve your retirement planning? And that's specifically the bucket that we're talking about right now. And you can use some of these principles to determine, okay, what's a good donor advised fund allocation? What's a good 529 plan allocation? But I would argue those are excluded from this because they serve a different purpose and different time horizon.
Jared, question for you. What about primary residence? Should that be included or excluded?
I would say excluded. But it's also, this conversation is very personal. I would say excluded because it's kind of less liquid, unless you plan on tapping your home equity as a function of retirement planning, right? Which could be a potential option, especially if you have multiple residences, or you've read the book Die with Zero and you're content on dying with $0 at the end of your life, or you're extremely philanthropic, I think that totally makes sense to include it. But most of our clients don't see that as a source of funds for retirement expenses. And so because of that, I would exclude it. But I'm curious what you would say.
I think from an investment allocation perspective, it does make sense to exclude it, to not count it. But it is interesting, worth pointing out, that there are significant planning opportunities where it must be included. A couple hypothetical scenarios. Let's say that you own, maybe it's an extraordinarily expensive house today. So if your home is worth $8 million and then you have another, $12, $20 million in investable assets, you don't have a taxable estate today, but you probably will have a taxable estate within the next decade or two. Another example, if you have a unique primary residence that could appreciate significantly faster than other properties. Now, Jared, financial planning would be easier if we could just know what the future returns of every asset class would be, right? So that would be easier. But I guess what I'm thinking here is if you're in a high growth area and your primary residence is on 20 acres, well, yeah, it's possible that today it's worth 1.4 million, but in 25 years, it could be worth, 8, 9, $10 million. And so then we have that same dynamic where that plus your liquid assets could easily put you in a situation where you have a taxable estate. And so huge amounts of planning need to be done for those scenarios. You also touched on something that I would reiterate. If, you think about maybe your primary residence is never going to be worth $9 million or $39 million, but maybe you have 2 kids and your 2 kids do not live in the same city that you live. Therefore, it's not that valuable for them to inherit a home. And so maybe you do at some point just sell the residence and make your estate planning process a little bit more smooth and seamless. So I think that's my answer. You're right, Jared. It should be excluded from your investment allocation conversation. But there's certainly lots of planning that could go along with it.
Love it. Yeah. And while we're talking about like real estate and kind of more obscure assets, I think that segues nicely into the next mistake we see, which is like mental accounting of certain buckets. And I'll talk about the 2 buckets specifically that we kind of find. So like one is vested equity comp that's just kind of accumulating. Like, right, we'll see a client with substantial company stock, a lot of it that has embedded gains, and they've just kind of been holding on to it. And it's a substantial amount of their portfolio. But because it's really in one employer and it's kind of an income source, right? Because they get it as a function of employment. They don't really include it. We oftentimes don't see it included in the allocation, or there's tax consequences of selling it. So, hey, it's just kind of this bucket of money, and then everything else is managed and diversified. So we see that excluded, but that's not only is it equity risk, but it's single company equity risk. So your allocation needs to reflect that. The other bucket, I would say, is cash above and beyond emergency fund. So, we definitely think, hey, there's a certain amount of cash that does not, you need to have liquid and ready for emergency funds. And the amount will be a function of you and your situation and your risk tolerance and, your income needs. But assuming you have that bucket of money set aside, we'll have clients, not include they'll have a bunch of cash in their brokerage accounts, and they won't include that in their allocation. They'll just include dollars that are invested in the market or in securities. But no, those assets, if they're not earmarked for, an emergency fund, those also are impacting your household allocation. We call it cash drag, where if the long-term expected return of cash is less than bonds or stocks, right? You're changing your investment return and investment profile by holding on to these assets, which isn't necessarily a bad thing. It's just bring awareness to it and include it in the allocation. And for some reason, from a mental accounting perspective, it's oftentimes just kind of excluded or ignored or discounted. Justin, any other thoughts or asset classes or types of wonky little securities that you would add to that bucket of mental accounting?
I think maybe you could make a case that some analysis should be done. Let's say that it is equity compensation within the company that you work for. So if you have a lot of equity comp that's going to vest in the coming years, maybe the rest of your allocation avoids that entire industry. But there's a lot of questions that go along with that, Jared. So if we're, if there's an employee at Apple and let's say they have a ton of Apple RSUs coming in the next decade, well, the first question that you really have to look at is how pure of a proxy, how pure of a representative is Apple of all tech stocks. So is there going to be a pretty strong correlation between how Apple performs and how, tech as a sector performs? If yes, well, then that's, kind of easy. Maybe you can invest in S&P X technology. If there's not, then it gets a little bit more tricky because maybe you do need significant tech exposure because other tech companies are doing significantly different things. In oil and gas, you could have the exact same thing. There's still, Jared, we've talked on podcasts that there are huge kind of deltas between the highest performing stock in the S&P 500 in a given year and the lowest performing stock. We also discussed how there's a massive delta every year, but certainly in the last few years, between the highest performing industry in the S&P and the lowest performing industry. But Jared, we could also look intra-industry. So what did the highest performing oil and gas stock do in 21, 22, or 23, or year to date? And then what did the lowest do? Theoretically, if a certain oil and gas stock was far more concentrated in natural gas, that could be a very different lived experience than an oil and gas company that was not. And so you're absolutely right. It must be accounted for. And then, gosh, the application, what you actually do based on what your high concentration is, that could be a lot of different things.
That's right. Because to say, hey, I have this concentrated single stock. Oh, I'm just going to code that as the S&P 500. No. The core, like one stock, its correlation to the S&P, it can be very low. So yeah, you need to incorporate it, and then also, figure out, how am I going to reconcile the fact that this underlying basket that I have a substantial portion of my net worth is structurally different than the asset class that it's exposed to, that it's correlated to, which is the S&P 500.
Yep.
All right, Justin. So let's keep moving here. So I think the other one, like the other error we see is like your investment allocation is stale. Like what I mean by that is like it was right at a place in time, but as risk tolerance, risk capacity, which we'll define here in a moment, those things change. They move over time, right? The timeline of when you think you're going to retire changes over time, right? As your kids grow up, as you get clarity professionally of what you want to do, what you want to get excited about. And so I think, really easy mistake you make is, hey, I'm just going to set an investment allocation and it's going to be static the rest of my life, which isn't a great way. It needs to be reviewed and revisited, right? In the scenario we were talking about earlier with the pension, that if that asset becomes liquid and you invest that and you say, hey, you had a 70-30 before the pension was included in the mix, and you take the lump sum on the pension and then invest that into 70-30, your household allocation has changed drastically, despite not actually changing your mix of stocks and bonds. So I think one of the big issues we see is just staleness, right? Of like, hey, this was appropriate at a time and place, but this is dynamic and it needs to be revisited like so many other things related to financial planning. Anything you'd add there?
Jared, I feel like it's kind of a little bit of a plug for why you need a very boutique, hands-on service experience, because you can't be in a situation where you're one of 600 clients for your advisor, and they got it through the compliance department to put you in a 90% stock portfolio 4 years ago. But now there's a lump sum pension. It's going to be rolled over into that IRA. There needs to be significant work done during that transition to make sure. And really, gosh, great point. Allocation can change constantly. There's a lot of different life changes. And so you need a tremendous amount of care and attention and detail within your financial plan and within just how your investments are structured. Gosh, Jared, another thing that changes a lot is withdrawal rate. And so, the one statement that I keep coming back to as we have this discussion, Jared, the one thing that I can't stop thinking about is it's never as easy as just invest in index funds. It's never as easy as just put your money in index funds and follow a 4% withdrawal rate. That, by and large is pretty sound advice for a lot of people, but there are 40 different moving parts within the investment allocation, within the execution of that happening. And withdrawal rate's the exact same thing. This is not retirement advice, so this needs to be done carefully under the scope of a CFP, most likely. But Jared, I mean, if you're 63, you could probably facilitate an 8% withdrawal rate for a handful of years as you delay Social Security, get a much higher Social Security benefit, and then take your withdrawal rate way down. And so I think there's just a lot of areas of planning, and investment allocation certainly is at the top of the list, that things can get stale fast for a lot of different reasons.
Yeah. And like, too, these, like all of these mistakes we're talking about, like they're not going to ruin you financially, right? But they're just suboptimal things, and suboptimal things compounded over decades make a meaningful difference, right? And so like none of these things are just like egregious, but we'd argue that over, little decisions compounded over decades can make actually a material difference in your financial situation. But yeah, it is overly simplistic. So we talked about a couple of terms that we were going to define. So now let's go ahead and define them, right? So I would say the last error is I would say fundamentally misunderstanding risk. And there's kind of two dimensions of risk. So we would call it risk tolerance, and how much risk, i.e. drawdowns, can I stomach and not abandon my portfolio at the worst possible time, right? So how much equity, how much volatility can I handle? And we've talked about this in a prior episode, but I would argue generally that oil and gas professionals, their risk tolerance is a little higher than the average industry, right? They've seen negative oil, they've seen the booms and busts. They have kind of an iron stomach, if you will. But the other thing, and I would argue the much less frequently considered thing, is risk capacity, which says how much risk do or don't I need to take to achieve my goals? And this one's interesting because I would argue it's, when you think about risk, everybody thinks about risk tolerance, but not risk capacity. So, if you have, $2 million and you need $200,000 a year to live, you probably can't afford financially to put all your money in bonds because the future expected return isn't going to support that distribution rate, even, right, considering that you have future Social Security and income, right? Conversely, if you have $10 million and you need $15,000 a month to live, you could hypothetically not take any stock risk, right? So you don't actually need market risk to achieve your financial goals. But Justin, on the the $10 million, $15K a month to live example, it's weird because if you think about that scenario, you're probably not going to spend down your assets, which means your assets have become legacy assets. So if you have legacy assets, whose time horizon and risk tolerance should you be considering? If with a decent probability that you're not going to spend down your assets.
Great point. Jared, if you have significantly more money than you're going to use in your lifetime, the textbook answer for what your allocation should look like is a really wide spectrum. It's okay to go lower risk if that's your tolerance. Jared, reiterate this, but you mentioned this. If you're investing in 2009 to today or 2008 to today, it really doesn't matter if you had the right allocation for your age and kind of your situation. If you weren't able to stomach that volatility, technically it would be better to be in a 50% stock, 50% bond portfolio than 90% stock, 10% bond, if you cannot stomach 90-10 and you're going to sell at the bottom. And 50-50 allows you to stomach it. So you made that point and you're absolutely right. But gosh, risk capacity gets really interesting. When we think about some of the clients we work with and being in a situation where, hey, your withdrawal rate is functionally 1% a year. And so if you have $50 million and you're spending less than $500,000 a year, Jared, there's just such a wide range. And a lot of things go into that. A lot of it comes down to, well, okay, what are we investing for legacy-wise? What do your beneficiaries, what do they need and how should they be invested? Their time frame should be considered. Simplicity of tax return should be mentioned. Jared, I made a post on LinkedIn about this and on Twitter or X, whatever you want to call it. But retired founder Jeff, he was on our podcast about a month or two ago. So he had 3 different exit events with the company he started. His exit events equaled like $90 million or $100 million. It's since grown to about $120 million. And Jared's super interesting to hear his thoughts on investment allocation. But he openly says, everything is funneling to Vanguard index funds with $120 million. He doesn't want private equity. He doesn't want private real estate deals. He doesn't want private credit. He's not looking to invest in viaticals. There's a million different sexy investments. Oh, he hates being an angel investor, does not want VC. And Jared, we've had experiences with some of our clients in the 9 and 10 figures where there's not that some of that kind of appeal of cool investments goes away. And you start to think, hey, I want a little bit more of a straightforward situation. And, Jeff mentioned this on Sam Parr's MoneyWise podcast with his allocation. He had a 200-300 page tax return. It's delayed because he's waiting for a bunch of K1s. And he just got to the place where it was like risk tolerance, risk capacity is one thing. And then there's also this dynamic of there's no telling that these, alternative investments are even going to be public stocks. There's no guarantee of that happening at all. And why am I muddying up my tax return for it? And so all of those kind of factors go into the equation. But to your point about risk capacity, there's just so many. When assets get well above 10, 20, 30 million, 100 million, a billion and more, there's not necessarily a textbook answer for exactly what the allocation should look like.
Yep. It's not as easy as index funds. But so Justin, you touched on something important, right? That like the investment allocation needs to be reflective of like your stated goals and kind of like return, like, and be like something you get excited about, right? And like, Retired Founders is a great example because he doesn't need the, higher expected returns, and we can debate the merits of that of private investments. He doesn't need those. Like his risk capacity, he doesn't need to take a lot of risk, right? Public equity markets, the long-term returns of those have offered him more than what he needs, right? And by him understanding that, he can make an empowered decision to, exclude those and keep things simple. So Justin, to wrap up, you kind of touched on this with understanding kind of the risk capacity, but how would you, we've talked about mistakes of, hey, here's the missteps we see in constructing an investment allocation. How would you recommend somebody go about correctly constructing an investment allocation?
Look at your entire household. Look at every asset that you have, and then implement the right allocation across different tax registrations for the highest after-tax return. And always start with the end in mind. Start with that question of what is my ideal future life 10 years, 20 years, 30 years, 40 years from now? That should be a big driver in how your allocation is executed on day one. What would you add, Jared?
Yeah, I would say, get an idea of, hey, what is my risk capacity, right? And like you can use retirement projections using in-depth Monte Carlo analysis software, or just kind of back of the envelope as a starting point of, hey, if I'm going to save this amount, and this is my retirement time horizon, and this is the amount that Social Security and pension are going to produce. What investment returns, if I have a bucket of money that's worth a certain dollar amount, what does that need to produce over an extended period of time for me to have my goals, right? Risk capacity is really a function of, it's a math equation, right? So kind of doing the math just to get an idea, right? This is all so imprecise, especially if retirement's away in the distance, but doing the math, I think is helpful. And then I would also, I would start with the least dynamic accounts first, right? So once you've decided, hey, here is my investment allocation. Here is kind of at a global level, with everything considered, here's what I want for my retirement assets. I'd start with the least dynamic accounts first, right? Because if you think about it, right, with the equity compensation that has embedded capital gains and a brokerage account with embedded capital gains, those buckets are harder to maneuver into your preferred investment mix. I would argue 401k is also a little bit harder to move into your preferred investment mix because there's a defined menu of options. So I would start with the least dynamic accounts earlier, and then, brokerage accounts, cash on hand. Those things are easy to kind of fill in the gaps, if you will. But I think really just kind of understanding the mistakes and doing the work of, hey, what all do I have? What are my goals? What is everything included in the risk and the retirement asset bucket? And then just being strategic and intentional about, recognizing the differences of these accounts, but also reviewing it on an ongoing basis, right? This isn't an event, it's a process. So doing this and continuing to do this, I think, is a helpful exercise.
Absolutely.
Awesome. Well, that's where we'll wrap it up. Always love hearing from our listeners, ideas for future podcasts, podcast@brownleewealthmanagement.com. We'll see you next time.